program. And really looking forward to having your outlook for us on the fourth quarter. I mean, let me start by asking you, what your outlook is for prices, really, given, taking into account OPEC plus volumes, macro indicators, just a general overview from you on how bullish or bearish you are going forward from where we are right now.
Mondo, I think I get more bullish as time goes on. I think the outlook for the next few quarters is very constructive. Demand is delivering pretty much what it should be delivering. Most of the Wall Street models they've been wrong for a year. Well, they've been wrong for years,
Okay.
but they've been particularly wrong past year. I think they're wrong going forward. What we're expecting for the next couple of quarters is some fairly normal looking seasonal inventory builds. No glut, just normal seasonality starting from a base of very low OECD inventories. So nothing there really to destabilize the market. I think prices are pretty well supported at the moment. Still backwardated at the front of the curve. There's still people who want to accelerate their deliveries. There is still that tightness there in the prompt market. And so overall, I think it's much healthier than consensus currently believes.
Okay, Mark Howson, head of Asia for Welligence Analytics. Again, great to see you again, Mark. Let's get the Asian perspective on support for that thesis that Paul's presenting, which is everything's looking okay from a sort of economic point of view. There's support there, seasonal, etc. China, of course, being one consumer that's been supporting crude quite a lot and stockpiling. But just generally speaking, what is the sentiment of support from Asia, and of course the big consumers there going forward for the fourth quarter?
Yes, it's interesting, Diala, because actually the market is just a little bit supply constrained on the gas LNG side, and that is very much keeping these LNG prices at around about $11 per MMBTU as we begin trading the winter months. Obviously,
Mm.
there is this big increase in LNG supply, very much led by the US and Qatar, but it's only really started ramping up this year with LNG Canada starting up, but also Plaquemines on the Gulf Coast as well. So a little bit more supply. In terms of the demand picture, China is experiencing weaker demand this year as pipeline flows from Russia and their domestic production is ramping up. But of course, European LNG demand has been particularly strong this year. First half imports were up over 20%. A lot of that was due to the real fall in Russian piped imports into the European Union in the first half of the year, but also just a colder winter there as well, and gas demand actually staying stable there. So slightly undersupplied market at the moment.
Okay, Patrick Coulson, CEO of Insights Global, based in Europe. Give us your sort of Europe. Now we've got Europe-centric perspective on that. I mean, just with that, before we get into the nitty-gritty of actual products and where those are, but just the industrial sentiment, the recent sort of figures on economic activity. We had some support there for LNG, as Mark is saying, in the first half of the year. As we head into our next winter, what does industrial and consumer sentiment tell us for demand?
Yeah. So if you look at the prompt market, so the demand for instance, gas oil is quite sort of seasonally low. We've seen a less volume going up the Rhine, for instance, compared to, let's say, the summer months. So that indicates that it's not there's not that much demand going forward, although we're going into, let's say, the colder months. So probably from a heating oil perspective, there will be an uptick in demand. Stock levels at the moment are rising in the ARA region, which sort of signals, oversupply. It's not going that fast, the stock increases, but nevertheless, looking at the let's say the last year, they're quite on the high side there. Industrial demand is a little bit mixed. So, we're experiencing a downturn, for instance, in the energy intensive industries, as we have been in that situation for a long time after, let's say, the war broke out in the Ukraine, which increased the gas prices and is sort of weighing on investments and production in that sector. Refining margins are okay. If you look at it, let's say beginning of the year, they're okay at the moment. Not extremely high, but considering the situation, it's pretty okay. So
Pretty okay. All right.
yeah.
Paul, back to you. I mean, again, sort of we can talk about the US and Europe maybe in kind of in one bucket because the Europe, of course, follows the US from a sort of central bank policy point of view, macro leadership, if you like. We've seen the Fed cut, the first one come in a few weeks ago, more expected before the end of the year, small, albeit small cuts, and into 2026, into an inflation rate of 3%. At least in the US, what is that doing do you think, again, I mean, you gave us your overall perspective on how things are looking, but does that make the market nervous at all that we're going to continue to see, inflation stay, if you like, if not increase as we go forward, if we see these cuts come through, and how is that impacting other commodities?
I mean, I think you're seeing some market nervousness about inflation further down the curve, and see that the way the shape of the rates curve and where the 10 years been moving around, and generally, whether that is concern from the market primarily about inflation or whether it's about fiscal situation and US debt. I mean, certainly the dollar is reflecting all of that, and I think any that further disquiet is going straight into the dollar. It's almost if while outside investors may want to invest in the US, they don't want to invest in the US in unhedged currency. So you invest in the US and you sell dollars because you want to hedge in domestic currency. So overall, I think that nervousness is sort of there. But again, roll back to the kind of market we were looking at the start of the year or post-April. I mean, it's clearly more robust than people expected. I think demand is generally surprising to the upside. I think all demand in the OECD is surprising to the upside. It's held up pretty well in Europe, and in the US, it's extremely strong indeed, particularly at the top of the barrel. So overall, I think you always just have to. There's always a reason for finding the negative bit. And Wall
Yeah.
Street is very, very good at homing in on that negative bit and say, "Oh, look, oil, it's only worth $30, $40. Pick your number." But I think from there, take a more balanced view of that. Generally, things are much stronger than consensus had earlier in the year, and overall, it's not. Doesn't appear to be a calamitous situation, but clearly there are particularly some fiscal issues which need to be resolved right the way across Europe and North America. It's not new, but it's certainly a problem that is perhaps intensifying given recent government actions on both sides of the Atlantic.
Yeah, and I mean, the tariff, of course, the tariff debate and negotiations continue. I mean, a few headlines this week saying that those tariffs that have been implemented for products coming into the US are actually beginning to bite businesses and beginning to sort of filter through to cost. But maybe we need a few more months to actually see perhaps evidence of that. Mark, back to you, sort of on the LNG front. You talked about the current sort of prompt market, but let's get your sort of update from you, if you like, on sort of the more medium long-term outlook for LNG. Of course, we have the immediate 2-year supply scenario, and then beyond that, and where do you put that today? Have we seen an update on projects there? Have we seen a slowdown, a recalibration, if you like, with the world economy as the forecast that people are looking at the next 2-3 years?
Yes, I think the big surprise, Diala, and this touches on some of the points Paul was raising, was really kind of the impact of geopolitics this year, and in particular, the streamline of the US regulatory process for LNG export projects, but more importantly, even this threat of tariffs that is really propelling particularly Asian buyers, but also to a lesser degree Middle Eastern and European buyers to really invest in the United States, and the oil and gas energy sector is been one of the key beneficiaries of that. So the vast majority, over 85% of all the LNG supply capacity globally that has reached FID this year has been located in the United States. It was only Mozambique earlier this week, and then also Argentina, where other projects were launched. And if you look at what kind of facilitated, what was that catalyst for those FIDs being reached, whether it was the Venture Global project on the Gulf Coast or the Woodside Energy project, it was really a lot of new investors coming in, either international investors or kind of privately owned US investors, just kind of propelling those projects to reach FID. So if you look at where the supply will be on the LNG side by 2030, 32% of it will come from North America, which is a massive increase from the 21% that came from North America last year. So increasingly North American dominated market, of course, underpinned by the United States, but also Canada playing an important role in that as well.
Okay, Patrick, thanks for that, Mark. Patrick, back to Europe. Let's talk a bit about you had mentioned initially at the top of the hour, we were talking about, Russian oil and different impacts of that. But we have seen sort of an I suppose, an uptick in the sort of physical attacks on some Russian refineries, and that is kind of beginning to sort of obviously begin to show its face into the product supply cycle, whereas for the last 2-3 years, regardless of the conflict, we weren't really seeing too much interruption. There seems to be more talk of that now. Is that really because of actual sort of physical, impact damage on the ground, or again, is it just sentiment driven? What sort of recent headlines would you say the market's paying attention to on that front, and what replacement products are being planned, if at all?
Yeah, so you're referring to the Ukrainian attacks, right?
Yes, on the Russian
Russian
refineries,
Yeah.
exactly. Yeah.
As far as I know, that's mainly sort of having impact domestically, fuel shortages in Russia. Export flows, they're not going to Europe, mainly to other countries. On the global scale, obviously, that is supplying sort of refinery margins because products are becoming less available. So from that point of view, it does have an impact, definitely. And that's what I already said, right? So the refining margins are pretty okay in Europe, and increasing. So from that point of view, it does have an effect.
Okay. Paul, I mean, let's talk a bit about just, we've had, from a supply point of view, again, OPEC continuing to increase monthly volumes, albeit by sort of incremental amounts. Many people attributing that fact to the fact that they are actually now comfortable with current prices in the sort of mid-60s. I know if they weren't comfortable enough, they certainly wouldn't be adding more oil, even though it's very small amounts into the market. Where do you think the argument is at the moment for OPEC plus market management versus getting their market share? And do you see that? I mean, we see within OPEC, Saudi now also pricing into Asia. It did not increase prices again this month. Where do you think that is in the group and their thinking going forward? They've certainly stuck to the position of, we're going to now reduce those cuts that we made to support the market.
I wouldn't put it in terms of the unwinding the cuts to reduce support for the market. I mean, it's the other way around. It's a feeling that the market can cope with those extra volumes. And again, I'm going to revert back to where we started the year, which was there's a huge glut. OPEC can't add a single barrel, and even if they just stay where they are, there's an ever-increasing glut through the year. And what they've done is completely unwound the November 23 raft of voluntary cuts, started in the unwinding of the April 23. So far from not adding any barrels, they've managed to rationalize that structure, unwind those voluntary cuts. So we are starting from a position where the market has shown it will take those barrels. And I don't think the logic from OPEC has changed throughout this period. It's that those cuts were the voluntary cuts have served their purpose. It's time now to get back to a basis right way across the organization based on targets, and that's where capacity is really the key issue in finding out exactly how much capacity it is. Because what the voluntary cuts were doing, they supported the market in 23, but over time the market, and again, so I think I probably blame my fellow analysts more than per se the market. The market's shown that it's quite good at discriminating between bits of information. But the market thought that all of those cuts were actual barrels taken off they're all spare capacity, had all this nonsense throughout the year of, oh, there's 7 million, 8 million barrels a day of spare capacity. And some of that was getting fostered by the voluntary cut structure, the idea that those were all actual barrels of production. So I think there's a cleaning up process going on here, getting it back onto a more rational footing, revealing the correct information into the market. And I think the correct information in there is spare capacity is not overwhelming.
No.
Spare capacity is actually rather limited. I think as we move through the rest of this process, we'll see that spare capacity is, I think by the end of this unwinding, global spare capacity is going to be perhaps 2%, maybe a little bit less than 2%. Now, it used to be said that 5% was a reasonable level, down to 2%. There aren't many industries in the world that are running at 98% capacity. Oil has always been unique in that we run at 98% capacity, and yet people say, oh, there's a glut, there's a surplus, there's so much spare capacity. So I think in that kind of tidying up of information and just giving the market a clearer perspective, that's what these cuts are also achieving. But I certainly wouldn't, no way is it we're going for share, so therefore we're increasing production. It's not that. It's OPEC plus market signaling is much more sophisticated than that, and the market has shown itself this year
that they believe it. Yeah. That they have confidence in that. There's certainly more clarity, it seems now, going forward, and that spare capacity issue has been brought up a few times in the last few weeks. There isn't that much around it. The main question around OPEC, I think, is what are they going to do about baselines going forward once this whole pot is cleared up, if you like, which maybe perhaps we'll see some clarity on that going forward in the new year. Mark, what about Japan? I mean, from an LNG point of view, from a nuclear plan point of view, they were sort of have that as a parallel track to also the whole energy reconfiguration of Japan. But from give us your take there. Of course, politically, a few changes there as well this week with a new prime minister. Where's the sentiment there for Japan, do you think, from a demand point of view?
Yes, it's an interesting one because Japan always used to be the world's largest LNG importer, Diala, and then a couple of years ago it was surpassed by China. But now there is the possibility that Japan will leapfrog China to be the world's biggest LNG importer again this year. Japanese LNG demand's actually been relatively stable. The country imported 66 million tons of LNG last year, and most players would expect that to slowly decline, but due to two factors. One, this AI kind of generated increase in gas demand, but also the slower than expected rollout of the renewables means that LNG demand is still pretty flat in the country, which is a sharp contrast, of course, to China, which, as I said before, demand is down about over 20%, in fact, this year already. So Japan could very much kind of reclaim its number one position. And again, a lot of the players, they're looking for investment opportunities. Obviously, there's a close economic and security relationship with the United States. So looking at investing in projects on the LNG side, both in the lower 48, but also actually Alaska LNG, which has been on the table for a long time there. So, and that's in addition to their ongoing activities, investing in projects across Southeast Asia and also Australasia. So, still very active in the market, and despite some of the forecasts from earlier this year.
Okay, thanks, Mark. Patrick, I mean, Mark mentions AI. How much is that filtering into bulk logistics in Europe, for example, and other sort of logistics in general that move our oil around? Is that something that's established now? Is it just another phase of digitization? Where would you say that stands? I mean, I see behind you, tank terminals and data services and transparency. How much are we seeing that filter through to make a difference, to make a change in the logistics that we see in this industry in Europe, within Europe?
So, AI and data centers are obviously contributing to energy demand and energy demand increase. So definitely. But on the, let's say, more general level, I think the liquid bulk logistics is mainly impacted by either sort of mineral oil business and petchem business. Those are, let's say, the main business lines in Europe, and maybe also sort of biofuels. Now, if you look at the mineral oil business, it's kind of stable. The demand is stable. Yeah, logistics are quite robust at the moment. Freight rates, for instance, for barging are sort of holding on and at let's say healthy levels. But yeah, if you look at the petrochemical side of the business, that's a little bit struggling at the moment. Yeah, for instance, the transport logistics are really sort of suffering because low throughput levels are applicable, which is mainly the result of certain industrial sectors that are sort of coping with large and high competition from, for instance, China. If you look at the automobile sector, for instance, in Europe, there were news headlines of factories shutting down because their car inventories are too high. They're just not selling enough cars due to sort of competition from Chinese battery electric vehicles. And that is sort of going downstream into the supply chain and resulting in low utilization rates for these petrochemical factories that produce the plastics to make all these parts in these cars. So in that point, in that sort of sector, it's not going that well.
I mean, you've got the whole petchem competition with Asia, obviously Middle East and Asia, huge petchem facilities being built there. Paul, last week at the Energy Markets Forum in Fujairah, there was so much talk about a dark fleet. I mean, again, not a new topic to the market at all, but the questions around that were, well, no, we have now just a very settled situation, but the number of tankers percentage-wise that are joining the dark shadow fleet is only increasing, not the opposite. Yes, we want the oil to flow, but that there are now some concerns about how large that fleet is growing from an environmental point of view, from a safety point of view. Would you agree with that thesis, Paul? Is the market adjusting easily to the dynamics around the dark fleet more and more? It's fully settled now, 2 to 3 years into it.
I think there are some factors such as, the pure presence of the dark fleet means that extended journey times, there's much more oil in transit at any one time, because essentially we've replaced short haul oil movements by long haul oil movements. And so all in transit, the system has to hold more oil in transit. But again, you're still seeing people getting confused. Say, oh, look, there's more oil in transit. That must mean that there's a surplus or a glut. We go back to that narrative again. So, there's a little bit of confusion, I think, being caused that, of course, oil in transit is the highest it's been for a while because there's a lot more.
But I mean,
compared to war, there's a lot more oil in transit.
Yeah. But just to qualify my question a bit, that there's this year, there was some comments last week this year that there's a much more sort of, I suppose, a daily dynamic changes in the dark fleet. It was all a bit settled, but now the disruption to that has been, much more dynamic. But in the same token, the arbitrage to be made out of that is actually lessening because the market has grown so good and so accustomed to making adjustments. I'm talking from a trading perspective. Would you agree there's been a change in how the market is reacting and responding to that?
Well, no, and most responsible people in the market are not trading in dark fleet oil. I mean, it's
Yeah.
not a good trade to be into. You are signaling yourself as essentially, operating very much in the shadows of the market once you're in that trade. So I don't. I think most responsible traders don't deal in that stuff. Full stop. So in that sense, I don't think the market's got used to it. You said it's
Mm.
stable. I mean, this is not a stable situation. I mean, we have a country that's invaded another country and is now trying to sell its oil by putting them onto tankers which are not seaworthy, and that's going to be stable until the point that we do have that environmental disaster that two of them collide while they're doing various bits of shifting all around, or a beach gets ruined right the way through the Straits of Malacca. So it doesn't feel stable to me. This is not a normal situation. So in that sense, I mean, the market knows it's there, it knows it affects the data, but the idea that it's any kind of normal, I think, is incorrect. I mean, it's clearly an abnormal situation. And one which ultimately can only, countries are only going to get more worried about having these tankers moving around, and it just will take one incident. You've
Yeah.
seen the dark fleet moving through the Baltic and through the North Sea. It's now become an issue because some of those movements seem to be attached to sort of other motives. And so it's become a highly politicized thing. So I think probably the most unstable thing in the world at the moment is the dark fleet and Russia's
Yeah.
exports.
What
It's not normal.
I'd like to go to Mark to see what sort of the gas market thinks about the sort of the risk. What's the risk premium on gas tankers, if you like, that are LNG tankers that are making their way around the world? Just a quick look at that survey question, which will have the greatest impact on oil supply risk over the next year. I mean, again, with all these shenanigans and fun and games that we've seen in the Gulf, supply itself was never really disrupted. There is arguably a risk premium of $3 or $4 in the oil price all the time because of what might happen. But we've seen supply pretty steady. But what would have the greatest impact on that risk over the next year, if at all? More geopolitical disruption, at key choke points, US policy changes, demand weakness. Will that obviously impact what supply is put onto the market, and OPEC Plus and what it does going forward there? So which will have the greatest impact on moving the supply dial, if you like, over the coming few months? Mark, just to go to you, perhaps to close for us on that. I mean, is there concern in the LNG market on dark fleet obviously addresses oil. It's everyone's focused on that. But from a safety passage point of view, again, how much nervousness has there been, if at all, in the market on any LNG tankers?
I think, Daya, obviously there's always a risk of safety problems. I think probably the market's more focused at the moment on kind of this massive upcoming 50% increase in global supply that we're seeing by 2030. And just as a result of that, how will the market be able to absorb it, particularly those price sensitive buyers like India and other parts of South Asia? So what level will the prices go down to? And touching on one of the points you and Paul were raising before, there is a big increase in liquidity obviously coming into the market, and what effect that will have on reducing those traditionally very large price spreads we've seen between Europe prices and also US prices. So we do very much expect that spread to decrease as more liquidity comes out of the United States. Destination flexible cargo should help to reduce that arbitrage opportunity.
Okay, Mark, thank you. Paul, just give you 1 minute to give us your take on gold. Put your commodities hat back on in your focus previous role, and just give us gold again. We continue to see it up and up and up. It's going to hit 4,000 this year, according to many. Again, being seen as a hedge against that weakening US dollar that you were referencing at the beginning of the half an hour. I mean, further legs do you think that has to go? Is that going to depend on trade policy from what we see in the US? Is it going to depend on what the Fed does with interest rate cuts? How far do you think we could go?
Well, I mean, I think it goes back to, as we were talking before, the dollar has sort of lost its status as a safe haven. I mean, normally under current circumstances, you would have thought that money would have been going into the dollar, and always has done. Forward always has been a safe haven, and the kind of reflection of the dollar's loss of at least for the moment, a short-term of safe haven status, is money going elsewhere, and it's been primarily gold. I mean, there's bits and have gone into Bitcoin and other sort of assets, but generally it's not that gold is the new dollar, but gold is certainly the new short-term term safe haven. And so where you want to, if you think that process continues, then gold has further to rise. If there's going to be a reversal in the fortunes of the dollar, then if some of those market concerns are addressed about inflation and the deficit, well then gold may have difficulty maintaining the current trend upwards. But again, these are all circumstances which are actually very favourable for oil as well, because this is looking like a pretty inflationary environment, given, and with lots of liquidity. And it seems very unlikely that as every other asset inflates naturally under those macroeconomic circumstances, that oil gets left out. I think this is perhaps going to be the surprise of next year, is that as costs go up and the floors on oil prices start moving up as well.
Yeah, absolutely. Everybody calling it still very cheap compared to everything else, and so the trajectory has to be upwards. Thanks so much to Paul and Patrick and Mark for joining us this morning. There's this result of our, at least the people who've seen the survey so far will post more opinion on that later on in the day on socials. Thanks so much for joining us, gentlemen. Have a great week.
Thank you.
Thank you.
All the best.
Bye-bye.